In chapter 4, we'll take the concepts of double entry, which we learned in chapter 2, and expand on it. And so in chapter 4, we'll dwell on the effect of profit or loss on capital and the double entry system for expenses and revenue. So moving on, a business's primary aim is to generate a profit because without profit, the business would not have sufficient resources or the return to continue operating. So, what is the nature of profit and loss account? Profit means the amount by which revenues are greater than the expenses for a set of transactions. To calculate profit, we need to understand two key terms. One is the revenue and the other is the expense. So revenue is the sales value of goods and services that we have supplied to customers. So it encompasses all amounts that we received from customers as a result of sales of our goods or services. Expense, on the other hand, is the cost value of all the assets that have been used to obtain those revenues. So, all cost items that we have incurred in the process of generating revenue is called expenses. So, the two key elements, revenue and expenses, when they are subtracted, it results in a profit. So so the best possible aim for any company would be that the revenue is as high and expenses are as low, so give a profit. So if we look at the example, if the revenue is of £100,000 and in the cost of generating that revenue we had expenses of 70,000, we will subtract to result in a profit of £30,000. Sometimes the business conditions are not favorable and the performance of the business is not as good as we expected. In such instances, the revenue that we earned is lower than the expenses that were actually incurred. So this would then result in a loss, whereby the revenue is lower than the expenses. So what does this profit or loss, how does it affect our accounting as a whole? In chapter 1, we learned about the accounting equation, which was capital is equals to assets minus liabilities. So if we look at this example here and then calculate our capital would be assets of 10,000 plus stock of 7,000 plus cash of 3,000 subtracted by our liabilities, which are the creditor of 2,000. So this comes up with a capital of 18,000. Now, into there, the capital figure then increases or decreases as a result of trading. So in January, the whole of 7,000 stock that we have in our business, we sold it for 11,000 cash. So if we were to do this now, and if we were to calculate our capital again based on these changes and using this formula here, our new capital would be, we'll add the fixtures of 10,000, there is nil stock, and then the cash has increased from 3,000 to 11,000, resulting in a cash of 14,000. So the total assets would be 24,000 and the liabilities would be 2,000. This would result in a new capital figure of 22,000. Now, if we compare the two figures, the first figure before the beginning of the month was 18,000. And now the figure is 22,000. So there has been an increase in cash. What could be a possibility of this? The only result, the only possible reason that I could that the capital would increase would either be because the owner added in new money in terms of cash, or our existing business created a profit. So here we can see that the stock that we had of 7,000 was sold for 11,000. So we made a 4,000 cash on the sale of that stock, which resulted in a profit, and that profit directly increases the capital figure. So, if we were to find the actual profit based on just the differences of the capital beginning of the month and end of the month, a new the formula for that would be old capital plus profit is equals to new capital. We could revamp this formula, and to find the profit, we could subtract the old capital from the new capital, which would be 22,000 minus 18,000, which would result in a profit of 4,000. So that is one reason of how the capital would increase. Now, profit or loss and sales. So, sorry, here on the top it's another way of finding out if there is a loss, then it would actually decrease a new capital, which would be subtracted from the old capital. Now, profit and loss are or loss and sales. So, profit will be made when goods or services are sold for more than they cost, while the opposite will result in a loss. So, whenever uh, so if we were to kind of like look at a purchases and sales prices, we would be able to find out if it was a profit or a loss. So profit is made when the sales price is higher than the purchases price. However, if the sales price is lower than the purchases price, which is a cost, then there would be a loss. So that is connection between profit and loss and sales. Now, profit or loss and expenses. So sales was the revenue element. Now, if we look at expenses, once profits and loss have been calculated, you can either alter the capital account. How often this will be done will depend on the business. So generally, in the second chapter, we only focused on three accounts, which was the asset, capital, and liability. Now, as the business would trade, there would be revenue and expenses incurred in the day to day running of the business, which in effect would result in a profit or loss account. This would increase the capital account. Now, the profit and loss account, the daily revenue and expenses, needs to be accounted for in our accounting records. So, the way to do this is different for each different business. There could be separate accounts of revenue and expenses which would be maintained throughout the year, and towards the end of either the month or towards the end of the year, they would be aggregated. So all the revenue accounts would be totaled and all the expenses account would be totaled. The difference would be found out, which will result in one single figure of profit or loss, and this would then be added to the capital account. So in order to do that a company would maintain different accounts to separately to make it easy for them to record different items of income and expenses so that there is no confusion, and then towards the end of it would be aggregated. So some examples of income and expenses account or revenue and expenses account are explained here: commission account, bank interest account, royalties receivable account, rent receivable, overdraft interest, subscription account, motor expenses account, and extractor. The name of the account would generally entail whether it is a revenue account or an expenses account. So if we look in the first column, commission account, commission is generally earned on sales, so it would be a revenue account. Bank interest, as the name suggests, it's interest paid to bank, so it is an expense account. Royalties receivable, because it mentions receivable, which means we would receive it, so it would be a revenue account. Rent receivable again would be a revenue account. Overdraft interest, it is interest on overdraft accounts, uh, which is taken by the bank. So interest account again, it is going to be an expense account. So it takes a bit of understanding the different nature of the accounts and sometimes just looking at the name to kind of like understand whether it is a revenue account or an expense account. How do we uh, how do we record the revenue and expenses account in terms of the double entry bookkeeping? So as we had learned in our previous chapters, for each account there is either a debit or a credit. Here now we have revenue and expenses. So revenue is generally considered to be if there is an increase in revenue, it would directly result in an increase in capital, which means an increase in capital would be a credit entry. So all revenue accounts have to be credited, whereas an expense you can understand it to be a reduction in the profit of the owner and a reduction in capital. So a reduction in capital, which would be an expense account, would always be debited. So in order to kind of like make it easy for you to understand, Just understand that revenue is always debited and revenue accounts are always credited and expense accounts are always debited.